Hi. Let's learn about bondholder. A bondholder is an entity that invests in or owns bonds. Bondholders hold debt securities that are typically issued by corporations and governments. They essentially lend money to bond issuers by giving them capital. In return, bond investors receive their principal or initial investment back when the bonds mature. For most bonds, bondholders also receives periodic interest payments. An entity that invests in bonds is known as a bondholder. These investors purchase bonds directly from the entity that issues these fixed-income assets. Bonds are usually issued by different levels of government, including federal and local, as well as corporations. For instance, prospective bondholders can purchase Treasury bonds directly from the U.S. Treasury during new issue auctions. When investing in bonds, there are several vital areas that the bondholder must understand before investing. Unlike stocks, bonds do not offer ownership participation in a company through a return of profits or voting rights. Instead, they represent the issuer's loan obligations and the likelihood of repayment, and other factors influence their pricing. The coupon rate is the rate of interest that the company or government will pay the bondholder. The interest rate can be either fixed or floating. Some bonds don't pay interest to investors and instead they sell at a lower price than their face value or at a discount. A zero-coupon bond, for example, doesn't pay coupon interest but trades at a deep discount to the face value, rendering its profit at maturity when the bond returns its full face value. The date of maturity is when the company must pay back the principal, initial investment, to bondholders. Most government securities pay back the principal at maturity. However, the corporations that issue bonds have a few options for how they can repay. Some bonds are callable securities, meaning the issuer may redeem at a date before the stated maturity. The issuer's credit rating and ultimately the bond's credit rating impacts the interest rate that investors will receive. Credit rating agencies measure the creditworthiness of corporate and government bonds to provide investors with an overview of the risks involved in investing in that particular bond as opposed to investing in similar products. Bondholders earn income in two primary ways. First, most bonds return regular interest, coupon rate, payments that are usually paid semi-annually. The second way a bondholder can earn income from the holding is by selling the bond on the secondary market. Besides the upsides of regular passive income and the return of investment at maturity, one big advantage of being a bondholder is the income from certain bonds may be exempt from income taxes. Municipal bonds, those issued by local or state governments, often pay interest that is not subject to taxation. The rewards available to bondholders include receiving regular interest payments and a return of invested principal on maturity. Being a bondholder is generally perceived as a low-risk endeavor when compared to other types of investments, such as stocks. Although there are certain tax implications associated with certain bonds, there are some bond categories that provide holders with tax-free interest payments. Bondholders are susceptible to risks such as inflation and interest rate risk. They must consider the risk versus reward of being a bondholder, as risk causes bond prices on the secondary market to fluctuate and deviate from the bond's face value. Potential bondholders may not be willing to pay the full price for a bond if it's issued by a new company with little earnings history, or by a foreign government with an uncertain future. Potential bondholders can invest in government bonds or corporate bonds. Government bonds, like U.S. Treasury bonds, are considered risk-free with the full faith and credit of the U.S. government backing them. Corporate bonds yield higher returns than government bonds but come with higher risks. There are two inherent rights associated with being a bondholder: to be repaid the full principal amount once the bond matures, and for the bond issuer to pay the bondholder interest at the agreed-upon interval. Government bonds are issued by different forms of government, including federal and local governments. Corporate bonds, on the other hand, are issued by companies, usually those that are more established. Yes, there are instances when you can lose money on a bond. Bonds are generally considered safe investments, but they are susceptible to certain risks, such as inflation eating away at the returns of a bondholder and any taxes owed on the interest earned. Here are 4 key takeaways. 1. A bondholder is an investor who acquires bonds issued by an entity such as a corporation or government body. 2. Bondholders essentially become creditors to the issuer, and so bondholders enjoy certain protections and priority over stock, equity holders. 3. The holders of bonds receive their initial principal back when the bonds mature, in addition to periodic interest, coupon, payments for most bonds. 4. Bondholders may additionally profit if the particular bonds that they own increase in value, which can then be sold on the secondary market. Hope this would help. Thanks for watching.